I'm Jayna Bhullar, Senior Investment Consultant and Head of Multi-Asset and Diversified Growth Fund Research at Quantum. I'll be talking to you today about multi-asset diversified growth funds, including the history, the role they can play, the criticisms they have faced, and to what extent we feel these are justified. So the purpose of this video is to share some thoughts and insights with you. It should not be considered as advice to any investor. So taking it back to basics, what are diversified growth multi-asset funds? We use the names interchangeably, but ultimately we are talking about funds that dynamically invest in a mix of assets to generate growth, typically 3 to 5% in excess of cash, whilst actively managing downside risk, which is often measured using drawdown relative to equities and/or volatility. This is achieved by actively allocating and switching investments in a variety of asset classes, which can range from traditional asset types such as equities, corporate bonds, government bonds, and might extend to less liquid assets like alternatives, infrastructure, and derivatives. DGFs are built on the premise that the same asset class won't consistently outperform year on year, and therefore a dynamic approach is valuable, particularly during times of market stress where financial markets can move rapidly. This contrasts with the approach we saw in the late 90s and early 2000s, where investors were believers of blending assets and the benefits of doing so, but it was done using balanced funds, which typically allocated 60% to equities and 40% to bonds with no active switching. A few DGFs were launched in the early 2000s, but it was really the global financial crisis that highlighted the need and value in being able to react quickly to fast-paced investment markets, and so DGFs really took off from there. I think it's important to note that although captured under the same banner of diversified growth funds, all funds are not the same, and there are distinct styles, and this includes funds that are more traditional in nature and generally invest on a long-only basis, but also those that have a more absolute return approach and might achieve this using relative trading activity. If we turn to the role they can play in a portfolio, this very much depends on the investor type and the purpose for the investment, particularly when determining which style to adopt. For example, for smaller investors, diversified growth funds can provide access to a variety of assets you might not be able to access otherwise, including alternatives and illiquid assets, and typically you would use a more traditional fund type here. By way of contrast, for larger investors, DGFs can act as a diversifier to complement a self-constructed portfolio of a mix of assets, and here you might use a fund with a more absolute return style or a contrarian fund, as that can be more additive. The main challenge DGFs have faced is around generating growth, as performance has sometimes fallen short of their cash plus targets and has lagged that of equities, which at times has been significant. The key thing to remember is the dual mandate, specifically the risk management objective of these types of funds, which does mean at times DGFs will be positioned more defensively, for example, holding government bonds or rotating into higher quality equities to help protect capital. If we cast our minds back to 2022, which was a particularly challenging time for markets, inflation was running extremely high following the post-COVID surge in activity, and rates were being hiked rapidly in an attempt to combat inflation. During this time, equities fell almost 18%, and simultaneously, we saw bonds also fall similarly in value. The global government bond index was down around 17%. And against this backdrop, DGFs did generate negative returns, typically in the region of 0 to minus 10%. There were actually a couple of DGFs that posted slightly positive returns, but ultimately this performance was very far behind the cash plus 3 to 5% target of around 6%, which on the face of it does seem disappointing. And when you look at longer term returns, it does feed through to that. But given the market environment, the performance is not entirely surprising, and actually the drawdown was considerably less than both that of equities and bonds, and that is often overlooked. If we take this back even further, let's say 20 years or so, we find that such funds have delivered similar returns to a static, balanced mix of 60-40% equities and bonds, but with significantly less drawdown. And just to add some context and numbers to that, so a mix of 60-40 was down around 30%, whereas DGFs tended to be down between 10 and 15%, so significantly less. And so the key point here is that the funds have delivered on their risk management objectives, albeit the growth hasn't always come through. So investors need to be clear about what they are using these funds for, have reasonable expectations of how it might behave in various market environments, and build their portfolios with that in mind. For our clients, we often use DGFs for their risk management benefit, and this is normally alongside holdings in equity that are there to provide additional growth potential, accepting that growth from DGFs might not always come through in the way you may wish or expect. As with any active strategy, success is heavily reliant on how the fund is managed and the choices that are made. Therefore, for funds we use, we ensure the processes they use are robust, repeatable, and that the funds are demonstrating the level of dynamism we would expect of this strategy type. We can't overlook the fact that DGFs have noticeably reduced in size over recent years. Some of the multi-billion-pound funds have more than halved in size, and a large part of it is the de-risking of defined benefit pension schemes. Having said that, diversified growth fund assets do remain significant, but it is something we are watching in terms of where future growth might come from, particularly as defined benefit pension scheme investment will decline. And that, coupled with the push for value and consolidation within the defined contribution market, could limit the future growth as well as commitment to these funds and strategies. So to summarise, we do think that DGFs can be useful, but we do urge investors to think about the purpose within their investment strategy and their expectations around performance and risk management.